Evolution of banking in India. Looking for information on the evolution of banking in India? Check out our comprehensive notes on the history and development of banking in India, including key milestones, major players, and the impact of modern technology. Evolution of banking in India. A. Father of banking in India. In India, moneylenders and loan sharks are known as the fathers of banking in India. 1. Lender, a person or a private institution which makes loans on its own stock but does not usually accept deposits or deal in dowry, is called a moneylender. Dr. L. C. Jain. 2. Sarafi Pedhiwale, a person or institution which lends money, accepts deposits and deals in dowry is called Sarafi Pedhiwale. Dr. L. C. Jain. B. Evolution of modern banking in India. A. Evolution of modern banking business from pre-independence period. 1. Agency houses. British introduced modern banking system in India. After the establishment of the East India Company in the 17th century, the money required for this company was initially provided by Indian moneylenders and moneylenders. But after some time the supply stopped and the servants of the East India Company established agency houses as a supplementary business. These agency houses began providing capital to the East India Company, lending to the food trade, issuing their own paper currency, and accepting deposits. 2. Bank of India. At the initiative of the British people in 1770, Bank of Hindustan was established in Kolkata. This is the first bank in the country. In the year 1832, this bank was also liquidated due to the closure of the agency house. Most of the transactions of this bank are Alexander & Co. These agencies were running with house. 3. Presidency Bank. These banks were established to provide loans in their respective regions or areas of operation. Bank of Kolkata was established in 1806. Also in the year 1809 this bank was named as Bank of Bengal. The government allowed this bank to print currency notes in 1823. After this, in 1840, the second bank named Bank of Bombay was established and the third bank was established in 1843 by the name of Bank of Madras. 4. Imperial Bank. According to the Act of 1920, all the three presidency banks, Bengal, Bombay, and Madras, were merged to form the Bank Imperial of India. 5. Reserve Bank of India. In 1920, the name Imperial Bank was announced as the central bank of the country, but it did not happen. According to the Act of 1934, Reserve Bank of India was established on the 1st of April 1935 as the Central Bank of India. In 1926, the Hilton Young Commission proposed the establishment of this bank, but this proposal was not accepted. This bank was nationalized on January 1, 1949. Later some parts of the Reserve Bank were separated and their Shikhar banks were created. For example, Exim Bank, OT, IDBI, etc. NABARD was established on the 12th of July 1982. 6. Private merchants and joint capital banks. Companies Act was passed in India in 1860. In the same year, the first commercial joint venture banking company, Bank of Allahabad, was established. In 1860, the number of banks increased. Because this year the principle of limited liability came into force. Alliance Bank of Simla was established in 1873, Out Commercial Bank in 1881, Punjab National Bank in 1884. 7. Cooperative banks. In 1882, the Nicholson Committee suggested to the government of Madras that agricultural cooperative banks should be established in India. B. Evolution of modern banking business in the post-independence era. 1. Banking Regulation Act. During 1947-48, due to inflation and war-like conditions, deposits in commercial banks increased. The Banking Regulation Act was passed in 1949 to regulate all the activities of commercial banks. According to this Act, the Reserve Bank is empowered to establish new banks, control the management of commercial banks, workmen, employees, and issue instructions to commercial banks, drawing, etc. 2. Nationalization of commercial banks. Commercial banks were busy increasing their profits more and more. This was of no use to the rural areas and the country's economy. So on July 1, 1969, the major commercial banks were nationalized and their capital became owned by the central government. 3. Provincial Gramin banks. In the year 1972, the Banking Commission suggested the establishment of Gramin Bank to provide facilities to the economically weaker sections. Regional rural banks were established on 2nd of October 1975.